Thank you. It feels very exclusive, so I hope you will enjoy the session. Let me introduce the panel. So Luis Picas, please come to join me. Senior Director Investment at HIP, part of Blackstone Group. Gerald, Hanna, Investment Director at Revetas, please. Peter Lenhardt, Director and Head of Hotels at IREMIS. And last but not least, Gregor, Famira, partner at CMS Vienna, who is also covering the Adriatic region. So good afternoon, everyone. I just wanted to start maybe with a little overview of where we stand today, because I think these days are pretty interesting. And what I find kind of in these days is a lot of paradox, and I hope we can talk a little bit about that with the panel. Indeed, there is a lot of equities around in the market, but very few deals happening, especially in this part of the world. We've seen record performances in 2022, but profitability and margins have been challenged due to cost. People, I think everyone wants to travel and take the plane, but it's just so crazy to fly this day. Flight had been cancelled or rerouted. Transactions of yield have reached record low levels, but borrowing costs have reached the highest level so far, and etc., etc. In this world of challenges and confusion, I'd like to hear from the distinguished panel about what is being said, the KPIs, but I would say more the challenges that we are facing these days when we are investing into hotels. So let me maybe turn into kind of, Peter, maybe if you want to start, would be great. You are sitting here setting up a new fund. Maybe you can tell us a little bit more about kind of the focus, but I'd like to kind of build on your experience. You've worked at Principal in the past. You've been focusing on hotel acquisitions, but your company was looking also at a lot of different asset classes. Maybe if you could tell us from your experience, what are the relevant parameters that are being used on other asset classes that could potentially be used for assessing hotel, or maybe comparing Apple with Apple in some way?
Thank you very much. Thank you very much, Frederic, for having me. I think you're asking at least two questions there in one. Let me start with a little bit more of the strategic angle why IREMIS was created. And the view is that there is so much change going on in the world at the moment. We not only have the post-COVID world, we have increased geopolitical tensions, and we have global warming. There's three trends that for us lead to fundamental changes in all real estate asset classes, not only hotels. And that paired with the fact that actually a lot of the asset classes, and you have asked how that compares with other asset classes that we were managing at Principal Real Estate Europe, compares, they are moving into more operational scenes as well. If you look at offices, they are moving into more serviced offices. If you look at resi, you have student housing, you have serviced apartments that are blurring the lines. And therefore, our strategic angle is that we believe that operational real estate always needed fundamental active asset management that understands the underlying operations, really knows the ins and outs of these operations, and can judge the risks that are associated with it. And therefore, I'm actually feeling quite excited being part of a small team that has its understanding in the hotel spectrum to grow and fully integrated hotel team as a division first, and we will move into retail thereafter, because we believe that these are the asset classes that are most impacted by the change I was referring to initially. Now, the second part of the question that you asked is how to judge an investment at the moment. And I'm very bearish, so I apologize for my negativity in advance. But I believe that there's a lot of risk in the market that we see. It's very difficult to price assets, considering the interest rate development that we're seeing and the inflation that in our mind will stay high for a relatively extended period, as it's driven by also the reverse of globalization, bringing a lot of product processes back to Europe and just increasing costs thereby on the medium term. And thus, as long as you understand the fundamental risks of your investment, your funding cost stacks up, and you're still hitting your return hurdles, I think, and you have an active manager who can actually do the transaction for you, I think you're good to go.
Yeah, I suppose you are a net buyer, so like you are bearish in your approach and your statement, which I think it's fair. And in the preparation, like you were talking about one metric that could be potentially quite useful, and you were talking about, everyone is talking about yields, RevPARs, GOP margin, and so on. But you were looking at kind of like a price per square meter and kind of like how this could be maybe applied for the industry.
Yeah, I mean, in preparation for this panel, we were discussing, what are the KPIs and how is the industry changing? And obviously, we see service departments and apart hotels that have performed extremely well during the pandemic, had much more stable operations. But the issue I have with those as an investor is that obviously on a per square meter room size, they occupy more space. So how do you compare those to more traditional hotel products? And how do you compare more automated products than standardized classical hotels with each other? And what we were coming up with is that you would need to look really at a GOP per square meter or something. The problem with that is that it's not widely available at the moment.
Yeah. So we'll work on that and try to find a solution going forward.
Please do.
Gerald, also at Revetas, you also invest in all type of asset classes. But I do understand that your primary focus yourself is hotel assets, right? In these challenging times, what does make you still invest in hotel properties compared to some other type of asset classes?
Yeah, thank you very much, Frederic. Thank you for having me as well. The way we look at it is that, and the reason why we think the hotel asset class is very appealing for us is really because a hotel typically offer great opportunity to create value in their structure, which is not necessarily the case of other asset class in the commercial real estate, such as office. And this is what we try and look for to sort of also connect with what you were saying a little bit earlier. I think hands-on asset management help us create the value add element that can really get us to the business plan KPIs that we're trying to achieve at the end of the real estate life cycle. In terms of the KPIs that we're kind of that we're assessing as we are looking into different investment opportunities. Nowadays, I mean, we are in quite a very special time when it comes to inflation, obviously. And we're analyzing very closely the impact of that inflation on the ADR. The top line obviously is highly impacted. And then we try and understand to which extent that inflation and that impact is actually affecting the recovery of that asset. And that sort of tells us whether that asset is on the path to recovery. And from there, we sort of look at it also from an exit standpoint, because we're a private equity real estate, so we ultimately need to have an exit strategy as well. I think that's really on the top line side of things. But when we look at it more on the bottom line, we obviously are very mindful of the operating cost. I mean, I think everybody's noticed that we're being very challenged with the utility cost and maintenance cost impact that it has. So on one hand, we've got a top line that is impacted by the inflation. And on the other hand, we've got a significant increase in cost. And then the question comes as to whether the margin is impacted, right? And from there, we sort of look at the overall business plan to see whether it makes sense or not. So that's kind of how we look at it in a very granular way.
Yeah, I mean, this is a big question, like, but how do you kind of compensate, like, if you, maybe on the asset that you have currently in your portfolio, like, do you then plan a CapEx program that will maybe help you to save some costs going forward in order to keep the margins at the level that are necessary for you?
Yeah, absolutely. I think we always try and have, as part of our CapEx, let's say, two main strategies, what we would call an offensive CapEx program, which would consist of an upgrade or an improvement of the rooms, the public areas of the hotel, and then we'd have something that is a little bit more defensive, which would probably take into account the improvement of the efficiency of the operation. And from there, we obviously have that efficiency element, which we build as part of our budget, typically where we can really create some savings, operate in a more sustainable way, and also try and be a little bit more compliant with the new ESG KPIs that are now very important, in today's investment, effort. So, yep.
Yeah. Okay. Thank you. Luis, at HIP, your focus is resort hotels, right? Which is what we see the most in this part of the world, especially in Greece, but also Adriatic region. You've been quite active also in Greece. You closed a few deals recently. You're also very active in Western Europe, right? And I wanted to, maybe for the audience to understand what are for you the key differences between deals that you do in Western Europe, like in Spain, for example, versus like deals that you do in Greece. Is there any difference?
Well, Fred, good afternoon, everyone, and thank you for inviting me. I would say, yes, we've been very active recently. In fact, at HIP now we own 72 resorts, 59 in Spain, 6 in Italy, 6 in Greece, but I believe that very soon we'll have some good news, and another one in Portugal. Okay, the reality is that at the end we are all Mediterraneans and Latins. Okay, but I would say that the fact that we have 6 hotels in Greece and 59 in Spain gives you a little bit of let's say, an image of how difficult it is to do business in Greece, right? So I would say that at the end, the sourcing and approaching, the main difference between the two markets, for example, Spain and Greece, is that in Spain you have all the institutional investors there, so there is a lot of liquidity. Assets have been through several due diligence, okay? But in Greece, it's a little bit different. In Greece, it's extremely fragmented, and there are not so many international investors, right? So when you face, for example, a due diligence, probably you need to be, let's say, ready to find difficulties that, let's say, if you are a pure financial investor sitting in Berkeley Square, maybe, let's say, that could be a pass, okay? But since we come from Spain and we can understand how to manage and to accept that in our business there are some risks that you need to take, let's say that this is something that when you do the due diligence in Greece, you spend more time in the urbanistic side. Then, of course, the language doesn't help a lot. Okay, it's really, I don't know how you're fluent in Greek, but it's very difficult to let's say, to speak in Greek when you are in Italy, Spain. Let's say the advisors when you share documents, etc. It's also quite kind of different. But at the end, the main difference with the market is the institutionalization. I think that since we entered in 2019. Other institutional investors are coming and more will follow, and this will help the liquidity of the assets. But the main difference, I would say, is that you need to focus a lot on urbanistic, the legalizations, for example. Here you need to understand that whatever was done before 2011, you can pay a fine and legalize. So I would say that the main focus is urbanistic. The rest, it's very similar. So this is a bit my view.
You partially answered my second question, which was like to the sellers in the room, like what would you advise them to do in order to prepare their assets for sale? You talk about the urbanistic, the legal part of the transaction. Any other kind of preparation tips that you would recommend?
Well, yes, I think that first of all, when we are, except for example, let's say the recent Sanikos transaction, which has been among institutionals, in general terms in Greece, we are always talking about a family that but by some reason has decided to sell. So my first advice could be like, understand very well and make sure that all the shareholders are aligned and they really want to sell. Because a property is like a Picasso, right? When you put it on the market, you need to close the deal. Okay, you cannot, and it happens. But it's good that when you go once, you go very decided and you put it on the market, and the buyer sees that as an opportunity that it's now or never. Right. Another advice. It's very difficult to provide advice, but what I've talked about legalizations. It's to make sure that everything is in line. In terms of urbanistic, then I would recommend that if you are going to open a process for institutional, try to make sure that you have a good financial advisor that helps you to prepare all the statements in USALI format and probably translate it into English. And then just let's say I would say that also to understand what you want to do with the asset. Because here the family sometimes doesn't know exactly if they want to sell, but they want to continue managing the property. Some of them want to sell, but the other ones believe that they will continue managing. So to make sure that, let's say that you want to know what is your role. Because, for example, in our cases, sometimes for us, it's very important to have local knowledge in Greece. So anybody, for example, when we bought the Louis hotels, that we bought 6 hotels to the Loiseau family, they kept with us, advising us in order to, let's say, to understand the different markets and find opportunities, right? So it's important to understand what they want to do, if they just want to leave, if they want to continue helping and growing the platform. So basically, in a nutshell, this is what, in my humble opinion, I would recommend to a seller, right?
Okay, thank you. Gregor, staying maybe on the legal side. A key obstacle that I see kind of in the SE region, and it's quite particular, I think, in this market, is that the OpCo, the operating company, is sometimes listing as a public company on the stock market. It's clearly a huge challenge for international investors to buy this kind of assets, and does bring a lot of delay in the process. Why is this that some of these companies have listed operating company, and what is the benefit of that, if any?
If any, yeah. Well, the reason for it is predominantly historical, because in ex-Yugoslavia, so in Slovenia, Croatia, Bosnia, and all the other countries, Montenegro, they are all now kind of countries with a lot of hotels. Every big company was, of course, state-owned, and when then it was privatized, the big companies with more than I think more than 50 shareholders, had to become publicly listed companies. And everyone got a voucher, and then people started buying these vouchers, but they never ended up with owning 100%. They own now 93.5% or whatever. And so they're still listed. And they have more than 5. Normally, we just did that with a Slovenian company with 5 hotels. They still have more than 500 shareholders that are of no use, frankly. Well, in daily life, it's more a burden than a benefit. But I think you can turn it around and see it as an opportunity that probably you don't have to pay 100% for getting 100% effectively. And we have already done it a couple of times, both in Slovenia and in Croatia, that we would then do public takeover bids over the time, frankly, at a very, very low price. And then people who didn't see a dividend over years are then, again, if you are selling and selling and selling, and so in the end, you come very close to 100%, and then you may squeeze out the rest. This is not just joy for the lawyers who earn money with that, but it's also it's an opportunity, I think, to buy that stuff fairly cheaply, or these remaining percentages.
Any advice you would give to sellers who have structure like this? And is it better to kind of try to buy out the minority stakes before they go on the market? Or?
It depends on what you want to achieve. Yeah? If you just want control, then 51%, or sometimes even less than 51%, the majority at the General Assembly is enough, and then you don't have to pay for 100%. If you want to operate it like a limited liability company, then you either need to get the number of shareholders below 50 in order to be able to convert it into a limited, or you can. What we just did, also in the case of that Slovenian company, we were splitting it up into PropCo and OpCo. But now the PropCo is listed and the OpCo is listed, and we're now thinking kind of that the PropCo will rather become the nucleus of a new fund, or a new regional fund, or just maybe a domestic fund, or Slovenian terms. The OpCo, well, they have now leased it out to 2 hotel companies, international operators that are now happy with it, and so they will probably stay as is. Yeah.
Okay, so good work for a lawyer then. Gerald, going to ESG. ESG is definitely becoming a key metric for pension funds and investors across the world. Hotels are complex assets, and looking just at the E part of the ESG, environmental part, it's often very challenging to kind of like turn around and do a proper property improvement plan that would make that property a carbon neutral building. I know that you quite like this topic at Revetas. How do you kind of like deal with this challenge?
Yeah, no, great question, Frederic. Look, I think there's two different approach to it. On the investment side, when we look at acquiring a hotel asset, the first thing that we typically do and that we have implemented as a minimum standard is to do a proper self-assessment. So we've sort of integrated as part of our investment process, the ESG due diligence sort of component to it, which before we did, but not in such a structured way. Now we do have a structure, we do have the proper, checklist, and we work with specialist companies that support us with this effort. And I think we really try and understand where the asset is in terms of its performance, in terms of its impact, and also in terms of what is required for us as investors to invest into it, to turn it into an asset that performs good to at least very good to excellent in terms of where it ranks based on some of the certification that we all know of, right? So BREEAM, LEED, etc. So that's on the investment side of it. When it comes to the operating asset, we take a very proactive approach. So one of the things that we did, for example, in one of our assets that we own, we have contracted energy supplies to be 100% of renewable energy source, which obviously came at a premium, but brought us the comfort that the impact that we have basically in terms of the utility consumption is positive. And then we have heavily invested into the machinery of the hotel, the chillers, the technology around the chiller, for instance. We've got rid of those diesel type of machines. We look at, obviously, the way that we operate the hotel, but always trying to be mindful that it doesn't impact the guest experience. So, utility consumptions, sensors, light bulbs, all sorts of implementation around the physical aspect of the property, which we think are making a good impact overall. And that's work in progress, so we don't just stop there. We have quite an aggressive plan actually to try and also look into, or we have already started actually to implement photovoltaic type of energy source on top of solar panels. Very hard these days to really get third-party contractors to support us there because of the demand, which is quite huge. But on the other hand, we know that ultimately this effort is something that not only we will benefit from, but that also the hotel management that we work very closely with will ultimately support. So overall, this is really like the approach, both on the investment side as well on the asset management side of things.
So that was the other side of my question. Are hotel chains that you are working with, are they kind of helping you achieving your objectives?
Absolutely. I think overall, hotel chains are also on their side being very, very supportive. Look, I mean, they also have a benefit to it because when you look at the GOP, the performance of hotels, they're typically incentivized based on the overall performance of the hotel, and therefore it's in their interest as well to try and make sure that the cost of it is efficient. So there's an alignment of interest. And I think this is really what we have been able to work towards together with our operations partners, And we continue to try and find that same alignment with the new operators that we're speaking with. So we think that overall there's a great support from the operators in terms of implementing ESG-related initiatives.
It's good to hear. Maybe before I kind of continue in the questions, is there any particular question from the audience that you would like to raise to the panelists? No, I continue. Just feel free to raise your hand.
Can I raise one for you?
Please.
How do you manage reporting on ESG, on particularly the E, so probably CO2? How does your operator support you on this? Because this is something we have found a little bit tricky in the past.
Yeah, I mean, that's a great question. By the way, so I think one important aspect of the reporting that often is not necessarily spotted is that we need to measure. In order to report, you need to measure. And how do you measure operationally a hotel? Well, you've got to have meter to start with, okay? And to have meters, you need to have actually a little bit of a strategy around where you're going to allocate those meters, who's going to pay for what. And when you have a mixed use, which is our case, where you have a couple of hotels, you've got a little bit of retail, you need to understand basically how you're going to allocate these costs, etc. But the first step is the implementation of tools that enables you to really measure your utilities properly. And from there, you can really extract the data, analyze it, and communicate it. And communication of the result is actually one of our key, I think, success factor in this field. We're actively and ongoingly communicating how we are performing in terms of consumption so that we know exactly where we stand. And we look at seasonality, for instance, as well. That's a very important factor. I mean, you know, summer is just over. We had quite a special summer. And we're entering into winter. I can tell you it's already almost winter in Vienna, where I come from. And we're already starting to implement measures there. So it's all about measurement.
Thank you.
Yeah.
Thank you, Peter, for your question. One for you now. Like your primary focus is city hotels, if I understand well, in terms of investment. You also prefer to invest into core and core plus type of investment, which are effectively leases or leases with variable component. We know that it's quite rare, a beast in the SE region. How do you find kind of this region interesting for you as an investor?
I mean, obviously, we're not going to spend the most of our capital on the CE region, to be very honest, and I'm sorry if I'm dampening any expectations here. But obviously, we have looked at assets, for example, in Athens in the past. Operators, they are out there, would give you a lease on Athens, potentially. It's a great tool to diversify. And what I would underline, and I think what's more important to our overall investment strategy going forward, and that's a lesson learned from COVID, is that we need to look at markets that have a good balance in terms of demand diversification between leisure and business. And I think this is something that Athens can really provide, and therefore I would be more than happy to look at an investment in Athens, even though I'm fully aware of the fragmented market you have mentioned and how hard it is to do deals here. We haven't managed so far, so congratulations to your 6. I would even extend it to a certain extent to Italy, actually.
So it's effectively like trying to partner with an operating company that can provide you this solution.
Yeah, and they are.
Yeah. And any kind of like requirement that you will have like for an opportunity to be interesting for you? You talk about the diversification of the market, but anything else?
It needs to be sizable, so at least 20 million is what we require, and it needs to be city center. It needs to be really a core asset if we move out to Athens, because you know if we always look at this from, at least with our core investors, from a German perspective, so Athens is already quite far away. If you go very far away, then you need quality within that product.
Okay, interesting. Staying with you, Peter, but different topic, and I'm trying to go back to the resort industry. I know that you looked at a large resort in Western Europe recently, but you looked at it in a very different way than kind of a typical resort, like with a focus on kind of the residential component of that resort, which I think can be quite big in some cases. Can you explain us kind of like what was the driving interest around this opportunity?
Yeah, I mean, we have long struggled with resorts, and we still do. The rationale we had behind is that if you take the hotel away from a resort on the beach, you're left with a beach. And the real estate value of a beach is always very different than the real estate value of a core city center asset. And therefore, for the pension fund and insurance companies that we represent, we find it very tricky to argue that this is an intelligent investment. Now, what we have found to work around this as a liquidity measure is that obviously if you have the opportunity to build apartments or sell apartments or build villas or sell villas around it, and we have had asset management mandates working for Amman where this is exactly the business case, you can actually create liquidity on the asset level so that you take your equity out already quite a little bit earlier before you need to exit the hotel at some point. And that, on the other hand, then works in our mind for institutional investors because the market of selling residential holiday homes is much less volatile than the investment market on the hotel operational side for resorts in our view.
Yes, Gregor.
May I ask you something here? Haven't many countries taken preventive measures exactly against that because they don't want holiday homes on the beach? I mean, in Croatia, the beaches are not sellable at all, or you may not build on them. And
well, we have looked at resorts in Spain. We have looked at resorts in Italy. I'm not familiar with Greece, I must admit, but that works. There, you can do it. Obviously, you need to analyze early in the transaction whether it's actually planning-wise possible to sell off those stakes, but we wouldn't only look at stuff where this is possible. We wouldn't take the development risk of getting planning for any of that. That's way too far on the risk curve for our side.
And the question, so like once you've sold all this residential, you're left with a hotel component, right? So but what do you do with that?
You either hold it, if the fund structure is set out to hold it on a long term, or you sell it off as an individual basis.
Right.
And I mean, the residual value is probably relatively small, and therefore the risk.
That's right. Yeah. Interesting. Gregor, COVID has shaken quite a lot the industry, especially kind of the small, medium-sized, and sometimes family business. And it seems like some of these investors are now finally contemplating selling their business after sometime few generations holding the asset. What's your advice when you are speaking to this smaller investor that are not used to sell hotels?
Well, first of all, as you mentioned before, due diligence is really a rewarding task here in this region, but far more rewarding than, say, in Germany or Austria, where things are as they are anyway, or probably more as they should. And the first thing is always kind of, you will not get away with it. Yeah. So whatever you're trying to hide in your closet, any investor will bring it up, and it's going to be a painful exercise. So better be prepared to be open if there is any planning risk. Then we often see kind of tax risks because hotels by families are sometimes driven like a kiosk or kind of on a cash preferred basis. Yeah. So we need to see that risk. We need to evaluate it, and then we can take our conclusions. Kind of, shall we probably sell only the asset, which then wouldn't bear any tax risk, or what shall we do with it? Yeah. And the second thing I've seen surprisingly often a structure there where the property and the operation are still in one company, and this is just difficult to bring to the market because the property, I mean, who wants to buy a property? These are special kind of funds, and who wants to buy an operational company is a completely different type of funds or venture capitalists or hotel chains or whoever is buying that. So you need to keep them, or if you separate them, you normally create more value altogether. And then the family or whoever the owner is needs to take a decision. What do we want to do, as you mentioned before? So do we want to keep the asset and rent it out, or then it's probably, or do we want to further on operate it and pay a rent? Yeah. I mean, what I think will happen is, or what I see that starts to happen is that these opportunities on the market are often with hotels that have less than 100 rooms and are not so interesting for investors. Yeah. Especially in smaller countries, then what are you going to do out of London with one kind of 80-room hotel in Montenegro. Yeah, that's just not good enough. But there are local funds now getting established that are kind of bundling these assets, and then you get to a proper deal size, and you can also take care of kind of cleaning up the mess there, which is sometimes there. And then we see a good example in Slovenia now, where they are trying to pull assets together with the clear aim to once in 3-4 years from now sell it bundled to a proper investor from abroad.
And you see more, like on your day-to-day activity, you see more demand coming from these smaller family?
Yeah, more demand to sell. Yeah, COVID has made people a bit desperate, and now comes the Ukraine war and then all what it entails, and plus inflation, plus. So people are some are a bit tired, to be frank.
Right.
Yeah.
Okay. Luis, we're seeing kind of as a property advisor, we're seeing the price gap between buyer and seller increasing these days, where seller want to capitalize on the great performances achieved in 2022, and buyers are becoming more cautious and really questioning where markets will go going forward. How do you see this gap kind of narrowing so that deals can still happen? And kind of like, do you have any particular tips?
Well, tips, no, to be honest, the gap, I think that will be increasing, okay, because it's true that, and we've seen in our portfolio that the performance of this year, 22, I don't know, we had like rates above 15-20% higher than 2019 on a like-for-like basis, occupancy slightly below, and the GOP margins, which everybody was very concerned because of the increase in the overheads, wages, etc. It's true that we have decreased 1 or 2%. So at the end, I would say that the flow through cash flow has been positive. So it's true, the hotels are performing very well, and the owners, let's say now, finally, after 2019, we had like a normal season without, almost the pandemic concluded. But for investors, and especially for our peers, it's true that there are some big uncertainties in terms of geopolitical uncertainties, increasing cost of debt, inflation, and I would say that not all of us, but most of them are a little bit on a wait-and-see position, especially because it's true that, for example, the increase on the cost of debt, now you can buy treasury bonds at 3.6%. So do you really want to get into a business where you will take the risk of or the urban planning, refurbish, find a new operator, bring an international brand to get like a 6-7% yield when you can have the other alternative risk-free? So I'm not extremely optimistic about this gap narrowing. Usually what happens is that then there are not so many transactions. But it's true that in our case, for example, as I told you, we are trying to buy another, let's say we want to double our size in Greece, and we have 2 operations on the pipeline that we hopefully will close end of the year. We also believe that there is an opportunity for each single property. When there is a good property with good bones, beachfront, close to an international airport, good infrastructure, let's say maybe you need to take, not say the risk, but to let's say regardless, to make an effort and buy it, because we also believe that, and then we will talk about cap rates, but the important cap rate is not exactly the cap rate where you enter, but the cap rate when you exit. And in our case, for example, we can play a little bit with the with the investment horizon. So it's true that in the next couple of years it's going to be tough, but I really think that in 5 or 10 years the situation will be much different.
So staying on the debt, so like how kind of this increase of cost, and I'm not sure if we have lenders in the room, but would be quite interesting to kind of like hear from your opinion as well. But how this increase in borrowing costs like influence your strategy?
Well, the reality is that higher, let's say, if you have a higher cost of debt and you want to get the same return, you should, let's say, the purchase price should be lower, right? It's true that also that you have a Euribor above 2%, so 2.5, the Treasury bond I already mentioned. So I really believe that there will be a cap rate expansion, okay? And investors will, let's say, will ask for a higher return. So let's say the assets, the valuation of the assets will be tight. Okay, this is a general, my general view. But it's true that then you need to go one by one and to study single opportunities and decide if let's say if you can enter at a lower yield that what you expected. Okay. But in general terms, I think that the yield will continue expanding and the pricing of the properties will be affected.
Peter, Gerald, do you have different opinion or?
I fully agree, actually. I don't really have much to add. It's a very good way of putting it. I think on the one hand, you have the debt market, which is more expensive. And that cost needs to be translated somehow. And the question is, are you able to really enter in with the same type of pricing? And if yes, how is your exit yield going to look like, your exit cap rate? And then the question becomes, what are you going to do in order to try and compress that yield in terms of how you're going to operate this asset? And what is the value creation type of element that you're going to do there so that you can really get your overall business plan to work and get to your returns, right? So I think it's pretty much the same problematic that we're all facing here, which really comes from the fact that financing is extremely expensive, and to some extent in certain market, of course, in some others maybe a little bit less, but or it's relatively overall the same problematic that we're seeing across different countries. Yeah.
Yeah, I would add two caveats. The one caveat is that I'm very keen to see what's going to happen to valuations over the next 12 months. With interest rates going up, I see that a lot of people will struggle to uphold their valuations, and I'm very keen to see what the banks do then. I mean, they have been stretched throughout COVID, scratching covenants and extending covenants. Whether they do throughout this period, I make a question mark behind it, because it may be an extended period of higher interest rates, and that's where I think the trend will go. And the second caveat is an old grandmother's saying, buy cheap, sell high. So I think the cap rate going in actually matters quite significantly.
Yeah.
Thank you, Peter.
Mm-hmm. No, I wanted just to add, it's true that at the end, let's say, I don't know, but we need to be ready for a, let's say, long-term cost of debt, okay? I don't know if it's expensive or not, because if you look historically, maybe where it's not so expensive, but what it's true is that it was very cheap, okay? And there was a lot of liquidity, so let's say valuation was very important. Let's say the valuation was affected for this excess of liquidity, that in order to be not so bearish, but trying to see a bit, to change a little bit the bullish mind, at the end where the resort is an industry that now, after the pandemic, has been reinforced. Other investors with like Core Plus are now entering into the resort market, which was not so much predictable in the past. And at the end, it's an industry where we've seen that we are able to somehow compensate at least the inflation on our rates. Okay, so I'm optimistic about the performance of the properties. I don't know exactly about what will happen with evaluation, and I also agree that it's true that leverage families or leverage properties will struggle a little bit now that let's say that subsidies or measures supporting this pandemic will be released, right? And at the end, it's also very important that the exit cap rate, which is the real one, is applied on the, let's say, on the year of the sale, so 5 years, 10 years, right? So you can always when you're optimistic and you want to buy a property, let's say, you will find a way to try to find a business plan, increasing the NOI that you will apply to the cap rate, right? So trying to figure out which is the right operator, which is the right brand, that will increase the NOI in order to compensate the negative effects that we've been talking about.
Right. Yeah. Thank you. I think we probably have time for one question, if there is any from the audience. So.
Thank you. A very brief one. Having spoken about ESG before and the importance you give to, I've had the opportunity to moderate one or the other on green finance. And the sentiment is that there is some sort of spread between non and compliant and compliant ESG. Depending on whom you ask, this can be anywhere between 10 basis points to 100 basis points. Probably the truth is somewhere on the lower side. What's your feeling and how do you go about this? First. Second part, with regards to exit rates or buying in rates, cap rates, do you have a premium for those that are compliant or have an opportunity to be compliant, ESG compliant?
So maybe I'll take this one. In terms of the premium, I think, by the way, there was an interesting survey that your team has published recently, whereby it's been identified that the premium that applies on ESG compliant asset at exit goes between 4 and to 8%, but within that range. I'm not sure if I'm getting the numbers correct. So
correct. Is that correct?
You can confirm? Okay. Excellent. So there is actually definitely that premium, and that's something that has been observed and that has been confirmed by a big pool of investors. And that's not something that we can get away from anymore. So it becomes automatically something that needs to be fully built up as part of, let's say, the compliance related requirement that you implement in your day-to-day sort of asset management up to exit. In terms of green financing, look, I think overall, yes, you're right about in my view, about the 10 base. All I can do is confirm your observation, which is that there is that spread. It's pretty clear. We are speaking with our partners in the on the financing side of it, and that's something that's been clearly observed and confirmed. So this has also become an increasingly important element that we try and obviously address when we are, in the process of acquiring assets as well.
Thank you.
Can I add something? Sorry. I'm not an ESG expert, to be honest, but in our case, for example, we are trying to certificate either with BREEAM or LEEDs all our resorts. Okay, I really believe that at the end, and it's very good that the cap rate is affected. Okay, but and I don't know how to the dimension, but I really think that at the end, the important thing is that the property is sustainable, that you are, let's say, that you are not hurting the climate, and that you are reducing the amount of CO2 emissions. Okay, but in our case, it's going to happen that at some stage, it's going to be mandatory. Let's say we will have investors that will only invest in properties that are certificate. Okay, and so I think that is going to be mandatory, and I think that everybody needs to support this transformation. Okay, especially now that we've seen that the overheads are hurting, but it's not on financial point of view, but also, let's say, a more social point of view.
Yeah. Thank you very much. I think our time is up. So I know that there were some more questions, but we're staying around. So if people want to catch up, I would like to thank Gregor, Peter, Gerald, and Luis for your time today and talking about hotel investment. Thank you very much.
Thank you, Fred.
Thank you.
Thank you, guys.